Thank you very much. It's really an honor to be here. I'm always so pleased to be with my Lumen brothers and sisters. It's also very humbling to be in such great company on this panel that I'm here with. Steve is a good friend of mine. He's also a big client. So we're always trying to make sure he's getting what he needs. And we want to do the same thing for all of you. So for about 10, and I'll try to keep it, it's tough. I'll try to keep it to like 10 to 12 minutes on what I'm thinking. And for those who were here last year, I'm going to almost apologize in advance because it's really not very different. I wish, as Bob was saying, we sell this research to people. It's almost embarrassing because our call has largely remained the same for about 3 years. So, and you almost just to make it interesting, I almost want to get more bearish, or I want to have a different opinion. But if I'm being completely honest with myself, I think things are largely the same, and they're largely, in my view, very constructive, as we say. It's a fancy way of saying bullish on stocks. And we're going to go through these 5 reasons. I'll go through them very quickly here, and mercifully, I won't be chapter and verse here for you. We'll try to keep it interesting and show you some charts. The first concept is, again, we started this over 3.5 years ago, is this idea of TINA. And TINA stands for There Is No Alternative. And it was originally given, it was an acronym that was originally given to Margaret Thatcher because she would say, it was a very Keynesian period when she came into power, very Keynesian economic period. And she had these very, very free market ideas about the way to reform the British economy. And she would simply say, when everyone would go crazy, there is no alternative. And then she eventually said, the problem with socialism is eventually you run out of other people's money, right? So she said, eventually we're going to run out of other people's money. We have to change. We have to privatize British Steel. We have to all these things. We've been applying the concept to stocks, to say that really for pensions, endowments, foundation, anyone that has an actuarial assumption they have to meet, there is no alternative aside from equities. And so I don't know if you saw earlier this week or maybe last week, CalPERS came out, I believe they returned something like 2.9%. They have an actuarial assumption of 7.5%, right? So to keep even, they have to get 7.5%. The problem is, you have to get 7.5, you can't buy bonds. You can't be in cash. It's even hard to be in alternatives like hedge funds. You have to take more risk or lower the actuarial assumptions, which may happen eventually, but that's the last thing people want to do. And so I think in many ways this idea of TINA, it's gone from being like a nice girlfriend to kind of like restraining order type level of just persistence, in that you have to take more risk to get the returns that you need, and that hasn't changed. So the TINA is there. Monetary policy, as I'll show you here, we'll go to the next page. These are assets on central bank balance sheets indexed back to 100 in January 2007. And for those of you who were facile with monetary policy or very familiar with it, you would know that basically this is really, before the financial crisis, this would be considered illegal. It certainly would be considered not socially acceptable. And one of the things that's been happening over the last several years is you're finding it's kind of Marcus and Queensberry rules in terms of all the economic rules, which is to say there are no rules. And the main focus of central bankers and policymakers is avoiding deflation at any cost. And so what this chart is telling you, for instance, is the Fed's balance sheet is 524% higher than it was. It's 524% of what it was in January 2007. Right? Bank of England's is 475%. Swiss National Bank, 513. Bank of Japan and ECB only doubled it or tripled it. You want to know why it's been very difficult for active managers to beat the index? I would say this is Exhibit A, right? Because you're taking something that should be a variable, which is the cost of capital, and you're making it a constant. And you're making it a constant at 0. So it's very hard to add value when you're a professional money manager if you're taking something that should be variable and you're making it a constant. I'd say it's also one of the reasons why hedge funds in particular have had a very, very hard time over the last several years. I would argue this, though, too, and we'll talk about the Fed. I don't see this changing anytime soon. You know, the Fed may be starting to inch away from this view, but there's not a lot that's going to change, in my view, dramatically in the short term, even the medium term. Here's a quote, and I try to meld a lot of. Nice thing about being a strategist, you get to use a lot of things. You're largely entertainment, so you get to use a lot of what you're reading and a lot of what you're seeing, and you get to use it in your work. And this is a quote from Eric Sevareid. And Eric Sevareid, for the youngsters out there, and I'm actually too young to really know who Eric Sevareid was, but he was around when I was alive. But he was one of Murrow's boys. He was a CBS anchor. He said, the biggest big business in America is not steel, automobiles, or television. It's the manufacture, refinement, and distribution of anxiety. And if you think about that, you say, and he wrote this in 1974. Okay, this is 40 years ago, right? This is when the nightly news was a half hour a night. Okay, so national news was a half hour a night, local news was a half hour a night. That was pretty much what you were worried about. Now we're constantly being bombarded with all the things that can go wrong at every moment of the day. From an investment point of view, the reason why this is important is that if you look at this chart long enough, and I'm happy to send you the slides, what this is telling you is that this is the bull market no one loved. Actually, CNBC doesn't even refer to it as a bull market. They refer to it as a rally. And this rally, by the way, started on March 9th, 2009. It started 6 years ago when the market was at around 666, right? You're now at the S&P 500 is 2,100. So this isn't a rally, it's a bull market. And what this chart is telling you is that you've actually had net redemptions from equity mutual funds and ETFs together over the last 6.5 years, 6.25 years. Very, very unusual, and this is one of the things that makes me think the bull market could last longer, is that no one really believes it. Everyone's consumed by the anxiety. It's very natural because we all saw the face of God in a way during the financial crisis. But people are not invested in this. There's not the type of euphoria that normally is associated with a bull market top. As far as the Fed is concerned, I'll make this quick. I think there's a big difference between. I do think the Fed is going to start tightening or raising interest rates this fall. We're using September. The one thing I would say is the chances of the Fed actually getting to positive real short rates, or a level of the Fed funds rate that's above the rate of inflation, I would say that we don't see that happening until 2017. So another year and a half. And I would say, not to make a value judgment about it, but Janet Yellen, I can assure you, she is definitely on the left side of the aisle politically. And we could debate whether that's a good thing or a bad thing, but she is not going to be the person that takes the punch bowl away prematurely. So I know there's a lot of hand-wringing and gnashing of teeth about the Fed, but I feel very strongly we could talk about it in greater depth during Q&A. But she's going to proceed very, very cautiously. So I don't think you really should fear the Fed. I really think you should fear inflation eventually. And the good news here is that inflation's still very, very quiescent. There's really not a lot of signs. Eventually, the Fed is almost always late, even when it's trying to be early. And the Fed, this time, I can tell you, Janet Yellen wants to be late as a matter of policy. And what this chart shows you is that you usually don't have to worry until, let's say, wage inflation is up 4% year over year. Right now, it's only up about 2%. So again, it speaks to the idea that you have time. There's still time in the bull market to be bullish. This is, I don't want to make everything really rosy. I mean, there's plenty of problems. We could spend a lot of time on the problems. This is a problem, it seems to me. And this is the fact that Uncle Sam is $18 trillion in the hole, and 50% of what is outstanding, it's that outstanding, matures the next 3 years. In April, Mexico issued 100-year paper in euros, okay, to give you some idea. And this is, now, again, I don't offend anybody, but, Mexico being around in 100 years, that's not like 100% probability, right? I mean, the euro being around in 100 years, I would say, is less of a probability. And yet, they're doing it. And Uncle Sam is still issuing a lot of its debt very, very short term. And to me, this is a potential longer term. This is a risk, certainly in the bond market. I'll talk a little bit about the international things, which I think was originally what I was supposed to do, but I don't have that much material. I know we could spend some time on the euro. I know, 3 or 4 weeks ago, people were out of their minds worrying about what was going to happen, the existential threats to the euro. I know, as Steve knows, I know a lot about Italy. My mom was born there. I spent a lot of time there. And I tell you, aside from the Ryder Cup, I don't know anyone that refers to themselves as European. Okay, and I would say that in Italy, know a lot about Italy, that, it's hard enough to get people to describe themselves as Italian, much less European, right? That's a bridge too far, right? Being ruled by Brussels or something is completely out of the realm. So I'm not pounding the table and telling you the euro is going to be around forever. I think there are real existential threats there. Having said that, it seems like the ECB is very much, sticking to its word to essentially say whatever it takes, or believe me, it'll be enough. And what this chart shows you, it shows you the difference between Greek 10-year yields and the credit default swap spreads of European banks. And it might be a little bit, for those of you who aren't in the business, maybe a little confusing, but the top chart shows you that Greece is a mess. The bottom chart basically tells you that the chances of it turning into contagion are very low. That right now, the ECB has done a pretty good job, for lack of a better term, of ring fencing a lot of the problems. So I know Europe is, again, it's a mess. It's going to remain a mess for a long period of time. But the chances of it actually causing a great systemic problem for the global economy, in my view, is quite low. I know China is another thing that's on people's minds. And I think one of the things over the last couple of years, my little daughter, she watches this Frozen all the time. So I know this song, Let It Go. It's permanently, on my brain. But one of the things I've tried to let go as a strategist over my career is is letting my political views or my normative judgments about things sway my investment strategy, which is a lot of things, because a lot of the answers come in God's time, and a lot of the way people are compensated in our business is in human time, right? Which is to say, things may be totally wrong, and I would say China is a perfect example of a terrible misallocation of capital. But the chances of it blowing up, in my view, for what's practical for us as human beings in this business or professionals in this business, is not particularly worrisome. This is a country that has tons of currency reserves, and it's going to make the numbers be what they want to be. And I'm not arguing that it's a good system. I'm not arguing that it's not going to blow up spectacularly at some point. What I'm arguing is that it's not going to happen soon. Rates right now are, if you look at reserve ratio rates, for China, very, very high. They can ease very aggressively. I think they will. And again, I think they have enough reserves, currency reserves right now, where if they want growth to be 7, they can get it to 7. They might do that by building another Dallas that no one lives in, a very inefficient way, but they're gonna do that. The last thing I would point to we talk about international things before I turn it over to Steve. He'll talk about the stock market more specifically in the U.S. One of the places that we've been bullish on the last couple of years, and I think that now Japan is somewhat derivative of China. It's certainly their greatest trading partner. But one of the places that we've been bullish on, and it largely started out as simply a Bank of Japan or monetary policy story, is Japanese equities. It's turned into something different. And I know right now a lot of people are looking for structural reform globally, right? Because there's a lot of structural problems. certainly when it comes to public spending and all the rest of it. Sometimes, though, the structural changes happen not from the government sector, but they come from the private sector. Japan is one of those places, I think, right now, which is to say, I was very bullish on Japanese equities largely because of the Bank of Japan being so easy. Now I'm very bullish on Japan because it looks like corporations are focusing much more on shareholders, which is largely a non-Japanese view of the world. You know, it's not, the rights of minority shareholders are largely been ignored for a long period of time. There's a long history of that in Japan, but it's changing. They're really focused on return on equity. They're doing things to enhance the returns of shareholders. So it's very exciting to me just because when I started in the business, Japanese stocks were trading at 65 times earnings. They're trading at around 16 times earnings now. And there are real changes going on. So if you want to look outside the US, I think Japan is an interesting place